Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. 1 o'clock on the East Coast, back from Southwest Florida. That's Naples, Florida, not Naples, Italy. Dan and Guy. Carter Braxton Worth will be joining us. Of course, if it's Thursday, Dan, it's
Butters.
It's Butters. And let's get right into it because we just got off a plane. Here we are. This is the Jackie Earl Haley moment. If you pull up the rundown, I think some of you folks will know what I mean by that. Bad news is, in fact, bad news. We're going to take a look at Carter Braxton Worth's charts of the S&P, the NASDAQ, and some banks, AMAT, and Nvidia earnings preview. A lot to go through here. How are you, Dan? I know how you are because
we've been together for like 48 hours straight. It's a little much, right?
No, I mean, not at all.
So then we're going to, after this, we're going to go up and do the CNBC's
no, after this,
Fast Money.
After this, we're going to talk to Danny Moses.
Oh, yeah, we're going to do that. And we did
then we're going to
spend
go to CNBC's Fast Money.
All right, so it's kind of interesting, Guy. We've been going back and forth with like the reasons for the violence in the rally in the equity market, right, since that CPI print. And so it's interesting that, yesterday when we were doing market call at this very time, we are talking about, yields were up 10 basis points in the 10-year, right? But the stock market was actually flat up. Today, we got yields down, 9. So, like, what's going on
I don't know,
here, man? Like, it's kind of weird, right? Like,
think about, and we're going to talk about crude oil, obviously, but yields are lower. And I think today's yield move is not on any inflation stuff. It's more on economic data and just general weakness.
So this goes to the bad news is bad news.
This goes to the bad news. Again, that's just what that's my interpretation
just to play it through, just if we have some new listeners here. So if the economy is weakening, if the data is bad, then that means yields should go lower because, again, the Fed is going to, listen, and we can look at like expectations for rate cuts. They're getting pulled forward dramatically right now, right? So like, I think, a few weeks ago when we had the 10-year at 5%, I think expectations for Fed funds cuts were in the back half of 2024. Now they're working their way into maybe Q1.
April, May.
So that's the thing that I struggle with here, Guy, is that like we have equities that, kind of like high valuations relative to where yields are, relative to what expected growth is. We have high expectations for equities because we have earnings estimates that are up, expected to be 10% in the S&P 500 or more, year over year. We have a growing, like situations, and geopolitically. We have, like when and we're going to talk about crude, but when you see crude down the way it is,
on back of the moves, it's been going lower. And then you have this crescendo move lower.
And then you see President Xi, who's in our country, meeting with our president in kind of, in an okay mood, like ready to talk, ready to dance.
Yeah,
all I'm saying, though, he's worried about the economic data that they have there, the deflationary readings that they have, you know what I mean? So I don't know, man. It just seems a little dicey here to me. But
you made a comment on Fast Money last week about Tesla. Your point was the times that fundamentals matter for the stock, the 4 times a year effectivly. I'm just using
their earnings days
or days that the stock goes down meaningfully. The rest of the time, the stock goes higher. We'll look at charts and you can sort of speak to exactly that. And I think to a certain extent, that's what we're seeing here. There's this Pavlovian response in the marketplace. Yields are lower, stocks go higher. The Fed's got our back. The Fed's going to be cutting. We're not going to wait until early 2024. We're going to get ahead of it now. And I think that's what we're seeing. And this is in the face of, to your point, deteriorating economic environment without question. Walmart speaks to that, and a lot of retailers have spoken. And it's not just anecdotal. Now, you got it over and over again. However, all the market looks at is this very one-dimensional. If rates are going lower, if the Fed's going to move earlier than the market thinks, we are not going to wait around. We're going to get ahead of this, and we're just going to buy things up. And I think that's what we're seeing.
Which is really one of the dumbest, things.
You know what? Hold on. I agree with that 100%. And it flies in the face of everything that I've thought would happen, so it pisses me off. But if you're long a stock and it goes up 15%, the reasons why don't matter. That's just, we can get all dissected, and the reasons do matter, but whether you're long it for the right reasons or the wrong reasons, if it's going higher, you're making money.
Right.
So that's now, with that said, there's a musical chairs thing that's going to go on at some point that you have to be aware of. But in the here and now, I don't think people really particularly care one way or another why things are going
so I
higher.
feel like we've had a bunch of different seasons within this earnings season, this Q3 earnings season. So we're on the tail end of S&P 500 earnings, and I'm just looking across the board today. Look at Cisco's down 11%.
Yeah.
Look at Walmart is down nearly 8%. Yeah, it's down 8%. Palo Alto Networks, not a small cybersecurity company, down 6-7%. This is on their earnings, on their guidance. So it's interesting because we started out, earnings season with the banks, and like those weren't that particularly great, to be frank. And then we had a couple tech things that worked. Then we had a bunch of big tech things that did work,
not.
right? And so it just feels like there's like no clear throughway, in my opinion,
100%.
about what we learned about really Q4 visibility and visibility in 2024. But when I think about the situation that we just talked about with yields, I mean, like that's kind of the point. Oh, look at that one. All right. So that's the Cisco there, right? So
that's
look at
unbelievable.
Yeah.
But just I want to just sort of put a sort of bow on your point.
Yeah.
That speaks to exactly what my point is. Like, there's no necessary, good news, bad news. The overriding condition seemingly is what the Fed's going to do and what interest rates are doing. And that is the knee-jerk, first level, Pavlovian response that the market is taking in the face of some good reports and some disastrous ones as well. It's almost as if, the individual names don't matter and the commentary around it doesn't necessarily matter. The market's looking at one thing and one thing only.
Yeah, no doubt about it. All right. Well, let's bring him in. Carter
Love him.
Worth.
He would have been great down. He would have fit right in down there in Florida.
In Naples, Florida. He spent a lot of time in Naples, Florida.
Really has been there. A lot of work trips to Naples. Yep.
How you doing, Carter? I mean,
I'm good. How about you guys? Sounds like everything's fine. Yep. All good.
Everything's fine. Help us make some sense of this, because again, I think about a week and a half ago on Market Call, we were charting the 10-year U.S. Treasury yield. It just come off that kind of 5% zone. This was after that November 1st meeting, that auction that went awry, and we had that pretty dramatic drop in yields, right? And then we had what happened last week, right, with this CPI. So talk to us a little bit. If we have a market on the 10-year, it's 4 at 5. Is that fair to say? Like that's kind of where we're going to be stuck until there is some like another pivotal kind of event here. How should equities trade? They're at the midpoint of this range now that they've been in, and stocks are at the high end of the range.
Look, I think you have a very one side. The three big things, if you can say that, would be obviously the 10-year yield, the price of a barrel of oil, and the U.S. dollar, and they all were streaking higher. I think oil was 80, 90 a barrel, and people started higher for longer narrative on the street about rates, and oil's going to go to 110. Oil's collapsed. It literally has done almost $30 a barrel. The dollar is now breaking, and yields all not happening, not going higher for longer, the opposite. The final thing ultimately that breaks, in my view, is the equity market. Everyone says, no, you're not getting it right. If those things are breaking, oil and rates and dollar, then the stock market goes higher. There is no book. I got all the books in my library. There's no class. There's no guarantee that that's how it works. What we know is that recency is a big thing. And when oil was at $65 a barrel in May, and rates were at 3.5, recession, hard landing. All of a sudden, rates go to 5, oil goes to 95, up higher for longer, no recession, no landing. Now all of a sudden, oil's collapsing again. Listen, you stay away from all that. When something's stretched and everyone's in, like Walmart, you go the other way, right? This is it. Now, what do we know? Oil has broken. The dollar is breaking, and rates are in the process of breaking. And ultimately, does that mean stocks go lower? I think it means they go lower. But it can, go ahead.
Yeah, no, and so I guess I'm gonna kick it to Guy for a second here, because again, I agree with what you just said. But Guy, if you're just one of these folks that just doesn't want to over-index to all the things that they can't quantify in geopolitical land, and if you say to yourself, okay, so S&P earnings expectations for 2024, let's say call them up 11%. If oil coming in, if rates coming in, and the dollar coming in should be good for S&P earnings, then I'm going to stick it out until I get some confirmation that we are actually going to have something worse than a soft landing in the economy.
Input costs, to your point, are lower, but the flip side of that coin is they're also going to have things lower, and that's going to be theoretically demand is going to be lower as well. So you almost by definition, you can't have one without the other. I mean, there's a reason why all those things are going low. It's because weakness is permeating through the system, which at some point should affect demand. So my point is those two things will cancel each other out. And then the question is, are earnings expectations too high? I mean, I've seen as high as 14% expected EPS growth. I mean, that's a pipe dream in this environment, I think. But again, market doesn't seem to be focused on that at all. It's focused on, to Carter's point, one thing, until it's not. Until Carter's, what he's been saying for the last 9 months sort of comes to fruition. At a certain point, you're going to see rates going lower, which he's been correct. And then the stock market, what that level of rates lower is, I don't know. But what he's been talking about is happening right before our eyes.
Well, if you're one of these seasonality monkeys, the higher we run into year end is the harder we fall next year. I'm pretty certain on that. All right, Carter, let's look at the S&P.
Actually, one thing on that, and I was just looking at a note from June 30, which is important. So, and we can revisit it right here now about seasonality. It's if you look at the first half, the best first halves on record. So the top 12, this year was in the top 12. It was the 12th. As of June 30, the S&P was up 15.9%, right? Now, that's not the biggest. The first half of 1987 to June 30, we know what happened in 87. Of course, the market up 25. But consider the fact that this year, it's the top 12 first half year performance. Do you know what the performance is in the second half? If you look at the median and mean of the other 11, the mean performance is up 1.8%, and the median is down 1.9. You know where we are right now? As of June 30 to where we are right now, the S&P is up 1%. We're right on schedule. Talk about seasonality, or said differently, when you stuff yourself at the dining table, yes, in the first half, you don't have room for more eating in the second half.
Let's go to the S&P chart, and then we go to your Michael Strahan chart in terms of this trend, this downtrend line that we've been looking at forever, obviously has been broken. I thought when we breached the moving average to the downside, you might see, a backup to that moving average, a check back, as you would say, and then we'd fail. Obviously, that hasn't happened. But what it's created is a series of now unfilled gaps to the downside. So just have that visual in mind, folks, and we can come back to it as Carter will say, toggle back. And now let's look at the sort of the chart, the graph that Carter's brought with us to talk about all the unfilled gaps in the market right now.
Right. So here's a table first. We'll do the table and then a chart. And so there was one unfilled gap above, but we filled it. And so that's out of the way. Now take a look at, oh no, I'm sorry, we haven't filled it. Strike that. Here's the chart. Yes. Mm-hmm. So the sequencing or the schematic is very simple. If you see a blue horizontal line that used to be a dotted red line, an unfilled gap that then has been filled. And so we have, let's go back to the table and then we'll go back to the chart. We do have one above, 1+% above, and then we have all these gaps below. To fill the lowermost would be a 12%. So if we go back to the chart then, and one says, do those have to be filled? Not at all. But the notion, at least as I see it, that somehow we're on our way to big new highs, and those unfilled gaps just from the last, what about the one just from yesterday? Mm-hmm. That those won't be filled. That is literally pie in the sky.
So you've done this obviously for a long time. I look at this, I see what the calendar says. Thanksgiving is next week. If we could put that chart back up, I mean, I can say, given what Dan just talked about in seasonality, which by the way, I don't adhere to either. I just want to be clear, but there are participants that believe in the absence of news as we get to this point in the year, markets tend to levitate. So I look at this and say, there's a reasonable chance that last unfilled gap to the upside is filled in the upcoming weeks. And then you have a series of ones to the downside, which at some point will start to cascade into, coming to fruition, being filled. Is that, again, I know you can't predict these things, but do you look at
right. I mean, of course, no, what you said was, could it be Nvidia? Let's say Nvidia has a really big number, and it does what it has done in the past, which is prints up 22%, something just epic. Could that be the catalyst to get us up to the 45, 67 level and fill that gap? Yes, and then there would be none unfilled down gaps in the history of the S&P. But there would be, of course, these now 6, 7 unfilled up gaps from March and April, and then more recently in the S&P. That would be, one could say, look, I don't want to be short here, but if and as we were to fill that 45, 60, then I want to be large short. That would be pretty good technique.
Yeah. Hey, Carter, real quickly, because I know you have the same you have the same table for the NDX and NASDAQ 100, and we don't have to go through it, but I mean, a lot of the gaps are corresponding on different days. It's just the NDX; they're just bigger moves, right?
And there's more to the downside to fill them, almost 30%.
Yeah. So, I mean, talk to us like where as a trading vehicle right now. Okay, so we have the NDX that's up, 44%. The S&P, it's up more than 2 times, right? That of the S&P 500. Where do you want to lean into? Okay, so if we talk about these top 10 names, they make up 30% of the S&P, but they make up 50% of the NASDAQ 100 here. What do you think is a better trading vehicle for some who want to play the major indices? Maybe because they think, we're going to go back to the highs by year end because it's just a monkey trade, or maybe they just want to start fading this recent strength, which has gone up 10+%.
I mean, I'm agnostic whether it's SPY or QQQ, but maybe to your point, I had an inquiry from a large institutional PM growth manager, about 18 billion in his control, one fund, and he was asked about semis. And if we put the chart back of the NASDAQ 100 there, what I wanted to point out is I just responded that isn't the semi trade right now just a beta trade? So this is what I said. The S&P from its July 27 high to its October 27 low, which is the same sequence here as seen on the NASDAQ 100, dropped 10.9, but the SOX dropped 18. And then in this 13-day ricochet since the lows, guess what? S&P's up 10, 10 and a quarter. The SOX is up 18.6. The SOX is just beta. Right? I mean, it's the exact same peak, the exact same trough, and the exact same ricochet. So maybe the answer to your question is if one is predisposed to think that we are going to give a lot of this back and that some or many of those gaps will be filled, then I would just play the higher beta thing. I guess I would short QQQ or semis rather than SPY.
Yeah, no, that makes sense. We appreciate that. All right, let's look at regional banks. This is one that I think is really interesting, the KRE, okay, the ETF that tracks them. And if we just pull up your first chart without any lines or anything in there, when you look at this move, I really want to get to like why this kind of caught your eye. There are 2 big up days, right, in the last 2 months, or in the last 2 weeks, excuse me. Okay, those 2 days, and so talk to us about the significance of those were big volume days. They came on big days where yields were lower, right? Like if you think about that, why is this catching your eye? Because without those 2 days, this indice, this ETF looks like garbage. And granted,
and so
like it's going to go back to those prior lows, right?
Right. The interesting thing is that so it's a heavy volume up thrust with a gap.
Yep.
You get the flagging, right? That down move for about 7 sessions, then another heavy volume up thrust with a gap. A granted volume not depicted here, but of course there's heavy volume, and anyone who wants to pull it up on their screen now can see KRE. So it gaps up on heavy volume, pulls back on light, then gaps up again on heavy volume. Now, for that to be happening, and it's happening while it was almost back to the prior lows, but then that happens. That starts to set those May lows as good lows. And so you have the plunge of March with the whole regional bank, debacle, and then you make the new low in May. But to have this sort of aggressive price volume correlation recently happening above the May low, I think that sets the May low as the low. But let's put some lines in and then let's, take them away, put them back. Now that's a minor formation, right? That's a minor formation, so it has minor implications. But let's put in the trend line. And now let's put the formation in. So take the formation away and leave the trend line. We overshoot the trend line. We check back to it, to the penny, and we bounce off it. And we put our little minor head and shoulders bottom in there again. That starts to mean something. It's the word developmental comes to mind. It's nascent, it's young, but I think it's important. Let's add some more lines. Let's converging trend lines, a move above it. Let's put them all together. Now, how about the moving average? Let's try it with 150-day. It's starting to flatten. Let's put the moving average in the minor formation. Let's put them all together. And here we have it. So look, it's a judgment, but it's enough, I think. And then the final chart will really say why. It's enough to suggest, and this is really the kicker. This is a ratio chart. This is regional banks as measured by the KRE ETF to the BKX. So it's that broad swath of small and mid-cap banks, relative performance to JP Morgan, Citibank, Wells Fargo, Bank of America, et cetera. And that is just a prototypical bearish to bullish reversals.
Mhm.
Anyway, the note that went out to clients, I guess 2 days ago was, look, buy regional banks here as a relative trade if you want to be particularly careful or cautious, or outright for those who just want to be long.
Let's go back to just the chart itself and take a look, because given your work, it suggests we probably can get back to the July high. So if we look at just the chart of the KRE, you can sort of visually see it there. The July highs would be sort of the second point on the downtrend line. So that makes sense. But my question to you is a lot of this predicated on obviously the move in yields and then subsequent strength, a continued move lower in yields, in your opinion?
I suppose that you would have a concomitant, right? That's the word, a concomitant move, lower in yields, higher in, KRE. But I think it is important. And if you look at KRE's relative performance to IWM, that's another way to do it. That ratio chart is fantastic. So specifically this area of small caps relative both comparable large cap financials, but also relative to small caps in general, relative performance to IWM.
It's interesting. It got me looking. I saw the note a couple of days ago, and I was looking at the kind of options in the KRE, just like if I just wanted to kind of define my risk. And, implied volatility in the KRE has come down pretty dramatically over the last month and a half or so, since that kind of pattern that you're noticing, like it looks like it's kind of bottoming out technically, Carter, which is kind of interesting. So implied volatility has been coming in. It's come in for about 40 down to 30, while the actual, like the realized vol, how much it has been moving, is still fairly elevated, leaving me to believe that options look price kind of cheap, especially if you have conviction from a directional standpoint. I was looking at January expiration, January 19th options, and with the ETF at 44, like 40 or so, the January 44 calls costs about 240. Okay, so that's about 5%. Now you could say, well, that's a lot for an at the money call looking out, little more than 2 months or so. But if this thing were to actually have a sort of sharp move, like you suggest, that's probably a decent way to play it, especially how much this ETF and some of the individual names have been moving around. So I just wanted to take a look at that kind of quickly. Carter, we wanted to also catch you, so we appreciate the work on the regional banks here. Couple names. You just mentioned Walmart, and this is one where, Guy and I were on the plane this morning, and we were kind of on the way back from Florida. This was not a huge surprise to us, and you were on Fast Money, and we were talking about it earlier in the week. Just, it seemed like all of the positive sentiment in the retail space has been centered around Walmart for a good many months now. Okay. And as so many numbers, and you were on talking about it, I think, was it Monday or Tuesday? And you rattled off, you had a question. Someone asked you a question, and you rattled off a whole handful of brand name retailers that are trading at 52-week lows, despite the fact, you know what I mean? So what do you make of this Walmart? And Guy, I'd love to get your take on the consumer after that, but what do you make on the plunge, and what do you expect to happen from here in the next week or two?
Yeah, I mean, a steady, orderly uptrend, to be fair, but you could just look. My only comment on set was, look, it just feels so unquestioned. So like, hey, what could possibly go wrong? Costco's acting better, and but it's still, I mean, and this has nothing to do with charts. It's still Walmart. He's trading at a P of 30. They sell garden hoses and towels and cat litter. I mean, look, it's still a leveraged operating business, and people don't have to go into the store. It is not a steady consumer staple. And you say, no, that's not true. It's got groceries. Yeah, okay. So if it were really steady, why in the hell is it dropping like a cheap small cap stock? It's because it was overpriced, overowned, or some other variation of the two. Either way, now what to do? More importantly, yeah, you could be, I mean, I guess from my seat, I sell a lot of naked options. People don't like to do that, but there's a lot of fear now. So I'd sell you could sell the 150s for January. They'd probably get a buck. I don't know. We could look those up right now. I'm just guessing. You'll keep it all. And okay, so Walmart gets put to you at 149. That's not so bad. What are the January 150s?
The January, give me
Jan 150 puts.
I'm
So
guessing
Dan
a
will
buck.
look at it, and so I'll sort of opine here for a second, just because Dan's question to me was, what does it say about the consumer? You look at the quarter, and I'm sure a lot of people have. Quarter was fine. I mean, they beat on EPS, they beat on revenue, comps were better. Excuse me. If you want to knock a hole in something, operating margins came in slightly light at 3.9%. The street was at 4%. Inventories were down 1.1% year over year against 5.2% sales growth year over year. So that augurs well. So it wasn't devastating by any stretch. What was, though, Dan, was the commentary about what they saw going forward, which was not unlike what the Target CEO has said about the consumer going forward. It's obviously extraordinarily cautious. They are seeing things. Now, what we have said for a while, and Carter echoed this earlier in the week, Walmart really needed to be extraordinary in order for this trajectory to continue. And I think to a certain extent that Target quarter probably hurt Walmart because it obviously the stock rallied in kind, and then there was a bar set for Walmart to exceed. Neither of those things happened. But in terms of what it speaks to a consumer that probably is a bit stretched and probably is going to be challenged in the months to come.
Yeah, I thought what stuck out to me were those headlines specifically about, this is a company that when they started raising the red flag about, inventories and about some of the consumer changes that they had seen, this was last year, it was lights out, you know what I mean, at that point in early 2022. So again, I think tracking what they have to say about the consumer is probably more important than, let's say, the reaction that we saw in a Target or a Macy's this week, because it's interesting, Carter, and I know we talked about Macy's earlier in the week and you think it goes lower here. It had this really sharp rally.
Not today, but hey, look, I don't think look what it's doing. It's barely up.
Well,
after that great gap up, the stock's up 50 cents. I mean, I think you saw it.
So let's pull up the day chart. I wanted to pull it. I thought this was my point, Carter, was that obviously the technicals were weak, the sentiment was really bad, but it rallied in sympathy with a couple other really oversold names like Target. So they can pull up the Macy's, let's say, the day chart. So it had that gap and it's barely up right now. And now this is probably this is a great press right here, guy.
Macy's opened at 14 and a quarter. It's trading 13 and a quarter.
Now do a 3-day if they could do a 3
stock is down $1. Now you'd be like on a $14 item. That's a huge move on 42 million shares of volume already, Carter, in a stock that typically trades about 11. So you're already at 4 times normal volume. When you see a move of this magnitude, that sticks out like a sore frickin' thumb. And if this stock were to close unchanged on the day, by the way, that's not out of the realm of possibility. That, to your point, Carter, that's not
very
price action at all.
It's very poor price action intraday. Slippage like that and euphoria like that can't stick often is almost like a bell being rung. You're like, all right, there's nothing left.
Well, let's see if it fills in today's gap, and then it probably is a good price. Let's go back to the Walmart chart for a second. You asked about the Jan 150 puts. Okay, so the stock right now is at 156. Okay, so those are offered at
guessing $1. But
they're $1.75. Okay,
nice.
so you got So here's what I would say. If you wanted to press the Walmart, okay, and you thought it could go back towards those lows from, just a couple months ago and maybe back towards like 140 or something, the 155, 140, 145 put spread, so $10 wide, $1 out of the money, you could buy the 155 put at like 320, and you could sell the 145 put at about $1. So that's you're getting more, that's less than a quarter of the width of the $10 wide with the break even that's down to 2.5% or so. That looks dollar cheap to me, having all of that time between now and January expiration. Why were you thinking about selling some puts to the downside? You think that's a better trade there? If you were,
maybe no, I mean, look, it's really not my area. I do almost everything naked. Like for instance, I would sell the 150s. You're saying you're taking $1.70 for those for January. And I also sell the 165 calls. I'll bet you those are going for $3. And you're good then, unless Walmart's less than 145. I mean, I'd strangle it here. After a shocking drop in gap,
Yeah.
you have a
Well,
reset.
just, you know, for a programming note, we never detail naked stuff on the
Of course.
program.
That's why I said it's my thing.
No, I know,
People
but
will go for it.
the last
But
thing.
for instance, for fun, what are the 165s for January call? I'm guessing $2.5, $3.
No, they're not. Well, we gotta
Oh.
get an options chain up in
But
front
what
of
you
you
could
here.
do, you know, if you're inclined to that type of leverage, you could do a 1x2.
Yeah, against
in terms-
long. I mean, listen.
But I mean, there are a lot of things. Anyway, I understand what Carter's saying.
No. But like, you know what? Listen, you know, you and I did options action together for a very long time, and you know, one of the things we had a lot of interaction with a lot of retail traders, investors, you know, who love the idea of using options. They love the idea of learning about them and putting them as another tool in their toolbox. You know, it's one thing to sell calls against your long stock. It's one thing to put 1x2s on against long or short stock.
Another thing to be naked.
It's another thing to short a naked call or short a naked put, and it just takes one instance where something goes wrong and it changes your.
So here, let me just as a matter of technique, and this is not just me pitching, selling naked. So let's say one didn't want to sell the naked puts because that's dangerous. To be agreed, World War IX breaks out, but selling the naked calls. One of the risks of selling naked calls is it gets acquired. So I'm here to state.
Walmart
will never be acquired. So this is out. Okay.
Yes.
So now we got that off the table. And Walmart will not be putting up an FDA approval for an Alzheimer's drug it just invented. So that's out of the table.
Yeah.
So once you drop in gap like that, right, your upside is fairly limited. Selling a naked call is certainly much safer than selling a naked put. I like doing both because you get the premium on both sides. But either way, move on.
But don't do it in $10 billion software companies. Don't do it in $1 billion
biotech stocks.
companies.
That's
That's what we're saying. And that is actually a really great point. Okay, let's hit one other thing before we let you go. Tesla. I got an email from Worth Charting. I think it was on Monday afternoon, and it said you had a bunch of charts.
242.
You said Tesla's going to fill in the gap.
One chart.
Yeah. Oh, was it only one chart? Okay, to 242. It got there. It even got a little above there. We just put together a couple little charts here. So are you out of that? It filled in the earnings gap, and now it's contending with its 150-day. There was a gap to the upside from last week or so. What are you doing with this one? And do you like?
I mean, I think this is a perfect example of do nothing. Like there was just a moment in time where we could, at least that was the judgment play for a gap fill. You know, it dropped on, I think it was the 19th of October. Musk came out and said, you know, if rates stay high, EV demand will be crimped. Stock drops from 240 to 220. And then just 3 days ago, we were approaching the gap. It looked like we could fill it quickly. Okay, a trade in and out, 7-8%. That's it. Here it is. It's a pair of twos. Like what in the heck about this moment? This pattern right here says buy it. Nothing that I see. How about short it? Why? It's just in the middle of the tennis court. It's the problem with playing in the middle of the tennis court. The balls hit you in the knees. You have to play from the net or you have to play from the baseline. I would just not play here.
Yeah.
Trade.
I would just say that. So going back to a point that Guy made, I mean, the fundamentals of this company are not getting better. Okay. And let me tell you something, the lower crude oil goes, the less interesting buying expensive EVs that are in a massively deflationary death spiral, like for pricing, you know what I mean? And I just want to pull up this 5-year chart. Our good friend Doug Cass, we've been going back and forth, it feels like for months, highlighting not just short-term head and shoulders tops. This is the mother of all, in my opinion. And you could say I'm just juicing it up and I'm drawing them up and this and that or whatever. But man, oh man, if that goes back to the January 2023 lows at $100, okay, and you look, I mean, like people forget this stock in December of last year went from $200 to $100 in 5 weeks, Guy. Okay, so like it could happen again if the sentiment just were to turn, and it feels like it is turning.
Before we let Carter go, you know, it's interesting that depending on how you're looking, if you're looking at the screen, the shoulder on the right, or if you're the actual human being, your left shoulder, if you were just move that to the left on the screen, you actually see what happened when you put in a head and shoulders, because that huge move to the downside that we saw at $100 sort of basically galvanized that first head and shoulders. Now we're drawing it again, saying, you know what, maybe another shoulder has appeared, and maybe we're going to see a similar type of thing. So
it's a bit fugazi.
No, that's not what I'm saying, Carter. But you look at that and you see, we did. That's exactly right.
We did draw.
We did draw that last
Carter,
year.
Guy, tell me how bad am I at charting? please.
No. So that first right shoulder, in fact, you could find that on Worth charting right on the site. As it rallies towards 300 in July and October, is like, you got to crush this, right? Okay. Now it's a two right shoulder, like a weird camel, right? Some camels have 2 humps, 4 humps, who knows what they got. But the point is, yeah, it's a difficult level. The stock goes from 100 to 300, falters, and doesn't quite get even as high as the July high. And now, but here and now, right now, right? There's no real trade. Yes, looking at the very long-term view, you said, well, but I have a 3-year view. The head and shoulders is intact. But that's okay. That's just a 3-year view. Those are good, and then they're not good, and then they are good. Here and now, buy, sell, hold, it literally, by my work, is a pair of twos. No discernible opportunity up or down.
Fair enough. The technicals, it's like a pair of twos. I think the fundamentals are getting worse. That's just my 2 cents.
Fundamentals might say a 2-7 offsuit, Carter. You're a card player, so you know.
Yeah.
All right, CBW, thanks so much for spending some time with us today and our viewers and our listeners. That's Carter Braxton Worth of Worth Charting. You guys know where to find his fine work there. Thanks, Carter. We appreciate it. There he is. Look at him.
Old-fashioned technical analysis. Nothing slick, just charts.
Yeah. All right. We got a couple really important things to do here, Guy, before we get out of here. We obviously have butters. We're going to do that in a second here. The other one that really stuck out overnight was Cisco. And to see a company like this is a $55 billion revenue company that has exposure to a lot of different parts, whether it be government, whether it be telcos, whether it be telecom. Yeah, I mean, like, all right, tech, and then geographically also, right? And you see a gap that we had from 3 months ago when they reported, and that stock had just come off of like multi-year highs. It had been basically trending lower over the last few months, and even in this period where in the last couple of weeks, it's really underperformed too. So to have this sort of gap and crap here through the moving averages back towards those 52-week lows, I mean, this is not a good-looking technical setup, but fundamentally, I mean, this is a cheap company. There's a cheap stock here. And so when the cheap stuff, the big cheap stuff's not working either, doesn't it kind of get your antennas up about some of the other stuff?
And it's interesting because if you just took a snapshot of the earnings, EPS beat $1.11, beat by 8 cents. Revenue was, I think, a little bit better. Margins beat by about 150 basis points. Operating margins over 200 basis points. I mean, all those are really good things. And then they talked about, and then guidance. And that's when people said again, okay, great, you did a great job. Looking forward, not so much. And to your point about valuations, sometimes these low valuations are actually become a bit of a trap, because you can say that if this guidance is, if they're going to come in with this guidance, this stock, which was cheap, actually got more expensive on the move lower, which is somewhat counterintuitive. So you could say, and I'm sure there are people out there that can do the math, even with the move lower, Cisco might be more expensive on valuation now than it was 24 hours ago. And it's completely counterintuitive. But you think about the visibility that they have, they're telling you a bit of a story here. And if you look at all the analysts, Needham lowered their price target. Piper Sandler lowered to $50. KeyBank, I think, lowered their price. I'm just going through it. JMP Securities, I think they lowered their price target. I'm not sure. So what they are taking some solace in is some AI opportunities. I mean, okay, that's everybody. But obviously they didn't love the guidance.
So if they can pull up a chart from going back to like 2000 in Cisco, there's a really fascinating thing that happened, because I remember like it was yesterday. In November of 2007, the S&P, the NASDAQ, everything was rocking and rolling, okay? And Cisco came out. The stock was trading at a 52-week high, but it was also trading at a 7-year high. It was trading at a level that it had not seen since the year 2000, was careening lower on its way to being down 80%.
Trading $32, I think. The highest level it had seen, I think, in a decade.
And the stock closed. Okay, I remember that day.
Am I right, by the way? I think I'm right.
Closed really well. So if we can just cap it off at like December 2007, and maybe you can kind of show a little bit of that move. So they reported and they guided lower, and that was it, man. That was it for the NASDAQ. That was the top, okay, the S&P 500. So,
yes. And I know
it's a different company.
Exactly.
It's got different implications.
That's exactly right. But your point is well taken. That was the bellwether. That was one of the 3 most important companies at that period of time. And that, so now if you want to start to play that forward, What's reporting next week that has become sort of
it's Nvidia.
So we'll see. But I think your point is extraordinarily well
And it's,
taken.
you know what's crazy about Nvidia? It's got 5.5 times the market cap of Cisco right now, and they have basically similar revenues. Like so it's a $1.2 trillion market cap versus Cisco now that's nearly 2. And then again, it's gained Nvidia right there since it bounced off that moving average to it's gained to, look at that, it's gained to Cisco. How about that? All right. Well, we're gonna spend we're gonna spend a lot more time on that next week. AMAT reports after the close tonight.
Let's talk real quick about AMAT if 4%. I mean, the stocks I think is up 55% or something this year.
Yeah.
But let's just talk about the stock valuation. It probably trades, I don't know, 20 times ish or so. It's not
market multiple ish.
Yeah. The problem, of course, is the bounce we've seen over the last couple of weeks in the name, actually longer than that, the last couple months in the name has been pretty interesting, like a lot of other these names. The other problem is we're getting towards levels we last saw, I want to say, in January of 2022. So basically what all these things sort of topped out. That's going to be problematic. If we have a longer-term chart, Dan, I think we can see exactly what I'm talking about.
To your point about valuation, so it trades at 20 times versus the S&P at 18 and change. Okay, it's expected to have. So this is their fourth. This is the fourth quarter, their fiscal fourth quarter. They're going to report tonight. Next year, expected revenue growth.
There's the longer-term chart, by the way.
Yeah, I mean, listen, that's constructive, except that it might be setting up for a massive double top
which
here,
we've seen in a lot I things recently. So, and all these tops were made. It's not coincidental. November of 21, December of 21, January of 22. I mean, it's all right there for you to see.
So fiscal 2024 earnings and sales expected to be basically flat, up 1%. This is a company, a 46% gross margin company. So they make equipment that makes chips, right? And so we got some decent readings about CapEx over the last few weeks. So we heard from Global Foundries, we heard from Taiwan Semi. AMAT has obviously been taking some share. Some of their competitors have actually not traded well in the semi equipment space over the last couple of weeks with some of the earnings they gave. But again, this is not like a great growth story. You're not expected to have meaningful, earnings growth again until fiscal 2025. So I just say this is one where unless you're convicted of a big beat and raise, it's a no touch for me.
It's a commentary story. Let's hear what they have to say. Let's see if they reinforce to your point what you heard from Taiwan Semi, what you heard from Global Foundries, what the market is saying about Nvidia. Obviously, the reaction of it, you start to connect all these dots, and does AMAT reinforce it, or do they punch a hole in it? And we're going to know in a couple hours.
All right, last thing here. So we get a preview of John Butters. He is the Senior Earnings Insight Analyst over there at FactSet. He drops his Earnings Insight blog on Friday mornings, and we get a preview here on Thursday's Market Call. Guy, we are literally at the tag ends of S&P 500 earnings for Q3 earnings season, and Butters took a look at the uses of the term inflation. Okay, so inflation has been cited on the Q3 2023 earnings calls of 270 S&P 500 companies. That's surprising. I wouldn't you have expected it to be higher? Okay, the number is above the 5-year average of 224 and above the 10-year average 173. However, Q3 2023 marks the 5th straight quarter that this number has declined over peaking after peaking in Q2 of 2022. Now, what happened in Q2 2022? CPI was at what?
I believe it was 9.1%, if I'm not mistaken.
So at the sector level, the materials, 89%, and consumer staples, 86% sectors have the highest percentage of companies citing inflation. So talk to me why it's interesting that materials and consumer staples are the highest percentage of the companies.
Well, I mean, materials makes a lot of sense. I mean, you think about what they are, what they hinge upon. I mean, their whole reason for being is, what does inflation mean for demand, those types of things. Consumer staples, though, is really what it comes down to, because those are the companies that at a certain point, inflation is start to impact their margins, right? They'll be able to pass on the cost until they're not. Then you have this inflection point, and we've seen it with a number of companies since the summer where they were doing great, and then they stopped, their margins started to flatten out and decrease because they could no longer pass on the cost, and they fell off a cliff. What I find interesting, to your point, I would have thought it'd been more as well. I'm just curious, and I don't know the answer to this. Obviously, inflation is the word they sort of tested for, but I'm wondering if companies used code, not code, but talked about inflation in other ways. Not that that matters at all, but maybe that's
Well,
sort of an
All
explanation.
right, so this was my takeaway reading this report. And I thought, again, I expected it to be higher on the way up when inflation was going up and the stock market was going down in 2022. So off of the highs that we saw, the mentions of it in 2022, it was easy for executives to point to inflation that is out of their control, and they could talk about what they were trying to do from a cost standpoint or passing through, you know what I mean, like price increases and the like. But the flip side of it, I would have thought right now that we would continue to hear them. Maybe there's some opportunities to take a victory lap, how they manage their businesses
Right.
and that sort of thing. So
Well,
to me, that no, I know,
yeah.
and so I just think that's kind of surprising, because if we look around and we say to ourselves that 3.2% CPI, and and this is one thing I know a lot of people are all over the administration and they're political about it. They're talking about how much inflation has decreased off of. It's not, because it really is the rate of
exactly.
Yeah,
I mean,
no,
it's
so
it's upsetting to me.
I know. But my point is, like, inflation at 3.2% above the long-term average or their target of 2% is still very high. So that's the point of it.
It's again, yes, and I know you know this. I know somewhat you said it just to sort of agitate me a little bit, but it's fine. I mean, listen, it's not just this administration; they all do the same thing.
It's politics. It's politics.
And it's listen. You know what? If it works for the narrative, good for them. But the reality is, it's just inflation is going up. It's just going up less fast.
Yeah.
That's not meant to be nuanced.
So
that's just the math of it.
So my other takeaway is that companies are really having a hard time dealing even with it. So the point is, maybe they're just trying not to talk about it because maybe it's reflective in their lack of visibility and the like here. So, all right, I promise you this is the last thing, because this chart is amazing. Let's pull up Intel, and you see the stock is up 6%. It's blowing out, guy. Huge volume day. Okay, new 52-week highs here. And we just wanted to use a 5-year chart, because that breakdown level that we saw, that's about current levels here, $43, that breakdown came in mid-2022. And when it broke 43, and it broke that support that had been in place in 19 and 20, it went all the way down to like $24 or something like that. So here we are. We're back at this big technical level. Still a reasonable valuation. Still, some folks think that maybe Intel has finally, from an execution standpoint, gotten their act together. You and I are not chasing this name by any means here, and it could probably set up as a pretty decent like trading short. In my opinion.
You've been first, and I know you know this as well. The reason to own Intel for the last couple of years has been on valuation, and that didn't work out all that well, because the stock basically was upper left, lower right. I think to a certain extent what's happened here maybe is seemingly they've stopped the bleed in terms of some of their data center in terms of the deterioration we've seen in the business. So the market is saying, okay, that's over. We can start to wrap our head around this a little bit. I also think to a certain extent that Intel's sort of like a homeland security play, if you think about it. The weaponization globally of chips, and how Intel for the United States could find themselves in the catbird seat going forward as they build out these plants, which take forever to build. In this world, they could find themselves in a really great position. So I think there's a series of investors that are trying to get in front of that, I think.
Yeah,
that's my 2 cents.
So I'll say one last thing. So next year, revenue growth is supposed to be about 14%. But you ready for this? Earnings growth is expected to double. It's supposed to be up 100% to $1.87. That's consensus per FactSet. But here's the deal: in 2021, it was their peak earnings year.
Hold on a second. It was 3 something.
You're light. $5.50. Wow. Okay, so what I'm saying is, you know what I mean?
Unbelievable.
So just when you think about what happened to this company and the trends and the misexecution and this and that, whatever. So it could prove to be a really cheap stock, right? If they are on their way back towards $5 in earnings, but the jury is still out on that one. I would expect this thing to back and fill a little bit. I just wanted to kind of throw that one up there, because that chart that we have on a 5-year basis doesn't really show what's gone on here just over the last couple of weeks, but we thought it was interesting to bring it up. All right, that's it, Guy.
Fun show.
Yeah.
Busy week for us. Thank Carter for joining us on Thursdays. Typically, we have EY from SoFi.
We're going to have to double her up like 1 week on the market call.
Well, I'll be with her on Monday.
Yeah, you will. On the tape podcast that will drop.
Which drops on Monday.
Yep.
Go to your favorite podcast store. It's either Apple or Spotify, because tomorrow our On the Tape podcast, we'll have a conversation with Terry Duffy. We're in Florida, as I mentioned.
That was great.
That was a good conversation. I think folks will enjoy
a lot of stuff there. Hey, the other thing is, we want to get your feedback. You guys have always been great with the feedback. We have these little videos, these little sizzles that
Vignettes.
little things that we're putting on the TikTok. So follow us on TikTok. I think we're Risk Rehearsal Media.
It's what do they call it when things go viral?
Oh, they go viral. Yes. So let's make some of these videos go viral. We're also on the Instagram. Guy has an account. Oh, look at that. Guy.Adami on the Instagram. Sure. I'm Dan S. Nathan. And then we have the Risk Rehearsal Media account that I think our social media manager looks like that.
We probably should get rid of that because
you don't like it.
Well, no, I don't. But I also think there's a chance that we get, what do they call it when you get doxxed
put anybody
or something?
Doxxed. You can put anyone's face up
sure
there.
He's not happy.
I got kicked off of Twitter for putting Elon's face on
no, but
on my thing.
I don't think,
Well, they can kick us off of Facebook.
My sense is Zuck and I probably wouldn't get along that well.
You know what?
You think
you'd
we would?
probably call him Junior. You would definitely. You would walk up to him and say, "What's up, Junior?"
Absolutely.
That's what Guy does. Yeah. So follow us on the socials. We have some new social media marketing techniques we're trying out here. We got a crack team on it. And we want to hear your feedback. Tell us what you think and share those videos. They're fun.
Thanks for joining us, folks. I want to thank FactSet. I want to thank SoFi. Get your money right all on one application. Carter Braxton Worth, the great Mr. Butters. Just Butters to you. We'll be back on Monday. See you later, peeps.
Yeah.